We're here tonight in the heartland of our nation to celebrate the most successful first 100 days of any administration in the history of our country.
President Trump's bold claim made today in Michigan, but does it stack up? I'm Haslinda Amin. You're watching Insight, and we're dedicating today's program to examining Trump's record and what lies ahead. We have veteran money manager Mobius to assess the impact on markets and how the president's economic policies have rewritten the book across asset classes. Former NATO Supreme Allied Commander in Europe, General Wesley Clark, is with us to examine America's place in the world as Trump tests key strategic relationships with friends and foes. And Boston Consulting's Neeraj Aggarwal will share his views on the tariff turmoil that threatens to upend global trade. Our top story today, President Trump marking his 100th day in office. He's had his administration moving at breakneck speed, signing a record-breaking 142 executive orders during the period, including his landmark tariff plans. But the frenetic pace has also sent the government hurtling toward economic and political peril. The president's hastily implemented and frequently revised trade policies are sowing deep uncertainty among trading partners and in financial markets. We heard from Trump earlier at a Michigan rally where he continued to defend his economic agenda.
And to help these automakers bring their factories home as rapidly as possible, I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the U.S. You're not supposed to criticize the Fed. You're supposed to let him do his own thing. But I know much more than he does about interest rates, believe me. I'm proud to be the president for the workers and not the outsourcers, the president who stands up for Main Street, not Wall Street. You know, I like Wall Street.
Volatility has become the hallmark of global markets in the first 100 days of Trump's second term. The S&P 500 index down over 7% since January 20th, its worst post-inaugural slump since the 1970s. The Bloomberg Dollar Index has also fallen about 7% since Trump returned to the White House. But the most dramatic moves were seen in the bond market, calling into question the haven quality of treasuries, which have long been seen as the world's risk-free asset. Well, our next guest has built a reputation as one of the most successful and influential money managers over the past 30 years. Let's bring in Mark Mobius, chairman of the Mobius Emerging Opportunities Fund. Mark, good to have you with us. It's only fair if we assess Trump's 100 days in office against the promises he made. And he promised a market boom like no other, but suffice to say, it's been damaged like no other. How are you assessing Trump's first 100 days?
Well, I think the first thing we must remember that he has made revolutionary changes that affect not only the U.S., but the world. It's an amazing feat that he's accomplished in the sense that he's upset the apple cart, so to speak. So we're now in a new era, a new way of thinking about politics, about economics, and so forth. So the first thing that comes to mind is that we've got to get used to a whole new order, a new way of thinking, and also we've got to get used to uncertainty. We think uncertainty will continue for the next 3, 4, 5, 6 months, and we've got to get used to it. Now, when you have a situation like this, of course, it opens up opportunities. We've seen the market come down. Some stocks are looking very attractive, and most particularly, countries like India will be benefiting from what's happened with China, and the other countries that will benefit. So some of these emerging market countries will do quite well in this environment, but we have to wait until all of this evens out and we see a settling down of this uncertainty.
Mark, you talk about a new way of thinking. Suffice to say that, the market thinking has kind of seen a rewiring. Talk to us about the psyche of the investor right now. Is it about fundamentals? Is it about, keeping up with the headlines? How have things changed in the way markets think, in the way investors think?
Well, of course, as soon as Trump made the announcements regarding tariffs, the first thing he did, of course, was create this great uncertainty, and the market came down. We're looking at 20%, depending on what market you're looking at. Now, usually, when you have a drop like that, people start thinking, oh, maybe we should start picking up a little bit, or at least not selling anymore. And I think we've reached this point now. The next step, of course, is to assess what comes next and where the opportunities are. Obviously, some companies are going to benefit from this tariff situation globally, and some will not. So what we're doing is looking at the whole picture globally and saying, okay, let's make an assessment of what we can expect going forward. And what that means, of course, is a total new way of looking at trade, looking at politics, and looking at economics.
It's also a whole new way of looking at the Treasury market. I mean, we saw how yields surged 50 basis points in just one day. Take a listen to what Trump had to say about the bond market.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy.
Mark, is it right to reassess the safety of the Treasuries market and to question, whether or not the dollar should remain a global currency?
No, on the contrary. If Trump is successful in the policies he wants to implement, the dollar will get stronger, and the bond market will be very, very good for the U.S. More and more people will want to put money in the U.S. But we must wait until all of this pans out. Currently, it's too early to make an assessment, but I believe if those policies are implemented, we will see a very strong dollar and a strong market in the U.S.
What gives you the optimism this will pan out the way you're expecting?
Well, I think we have to be patient. We have to wait for the next 2, 3, 4 months to see how this all pans out. One of the things you must remember with Trump, he is in a bargaining situation. He is trying this, trying that, threatening this, pulling back. So you're going to see more and more of this negotiation and bargaining taking place. And within the next, I would say, 4 to 6 months, this will all pan out, and we'll see a settling of what the agreements are going to be with various countries.
Do you still maintain that all markets are in play right now, except perhaps China, which is the crux, which is the focus of the trade war with the U.S.?
Well, all markets are in play. There's no question about it, because everybody's uncertain. But you can see strength in some of these markets. For example, India is doing quite well. Some of these other markets are doing okay. But at the end of the day, the uncertainty will remain. And of course, China will be the big question mark. If China does not come to the table, and if no agreement is reached with China, then I expect China not to do very well.
How have you been navigating the market? Are you dipping your toes in markets you haven't before? What are some of the changes you made in your portfolio? And what in particular are you looking out for that will shape how you think, about where you place your money in the next few months?
At this stage, cash is king. So 95% of my money in the funds are in cash. We're playing a little bit with S&P 500 index funds just to keep tune of the market, because the S&P is a leader globally. But we're also looking at some of the emerging market stocks, but in a very, very careful way. I think right now we've got to keep cash and be ready to move when the time is right.
But keeping 90% of your funds in cash, it's really, really high. That's possibly the highest I've heard so far. Why do that? Aren't there enough opportunities out there for you to be deploying your capital?
Well, when you're getting 4 or 5%, with no risk in dollars, you're doing quite well. Of course, we're not going to hold that for the whole time. It's not going to be more than 3 to 4 months when we begin to do more, depending on where the market is. If the market comes down further, of course, we will be putting more money in.
Are investors right to think that the U.S. is less exceptional? And in terms of the flows that you're seeing so far, what is that suggesting?
I think what it suggests is that the uncertainty. The reason why you had a pullback in the U.S. and the market generally is that U.S. investors were pulling back and foreign investors were going back home. They were going back in cash and going back in gold. Gold, as you know, has surged and done very well. Now, that's not going to disappear overnight, but gradually as confidence comes back in the U.S., you'll see money returning from overseas, and of course the U.S. investors will be doing more and more. And don't forget, Trump is looking very carefully at the market. He's very concerned about the market. He doesn't want to see a big market crash. So he will be making adjustments and announcements which give a little bit more confidence for people in the market.
It's hard to be confident in the U.S. economy right now. The tariffs are expected to be inflationary. Take a listen to what Trump had to say about inflation.
We will end inflation, slash prices. We've already ended inflation, raise wages, and give you the greatest economy in the history of the world. That's already happening.
I'm not quite sure that he is right in thinking that he has slashed inflation. Mark, what's your take on that?
Well, first of all, let's look at oil. Oil is a big part of the entire economic complex. And you can see the price of oil has come down pretty dramatically. So that's number one. Number two, don't forget, these businessmen in America are not stupid. They're going to be looking very carefully at their costs, looking very carefully at their supply chain, and they'll be getting supply from other parts other than China. Now, some will be hurt badly as a result of the high tariff on Chinese goods, but others have already figured out. It's interesting to note that if you look at the number of containers entering the U.S. from China, it's about 1 million this last month. It's amazing what's happening. We're seeing a lot of products coming in anticipation of higher tariffs.
But when it comes to inflation, it's not just about oil. Currently, we have consumers in the U.S. in particular feeling not confident about the prospects of the economy, and they're not spending as well. I mean, what are the risks from all of that?
Well, of course, some airlines are now seeing lower passenger rates in the U.S. But if you go to the U.S., as I was just in Texas, spending still continues. There's no big change in that regard. And people will adjust to new prices, new ways of buying things and selling things. And so I think people are quite adaptable to what's happening. And I don't think there's going to be a big upset in that sense.
So consumer confidence at close to record low is not such a big worry right now. You see that improving?
I think it will improve as people get used to the ideas of adjusting their buying habits. You must remember, at the end of the day, what is it? It's food. Food prices in America should not be going up because America produces food. Fuel, oil prices down. This is another factor that it's all aspects of consumption. And if you look at housing, with interest rates the way they are, not very good, but at the end of the day, prices in housing are not going to be going up in view of the very negative attitude that people have regarding the economy. So if you put this all together, the guy on the street, the kind of people that Trump talks about, the working class, will not be feeling the pain very much, in my view.
How will this trickle down to the markets? I know that you're the emerging markets guru. How do you see the S&P performing by the end of the year? Some say it could be as low as 4450. I mean, of course, that's an outlier projection, but there's a lot of pessimism out there.
I think by the end of the year, the S&P will be much higher than it is now, because a lot of the uncertainty will be out of the market, and people will realize there are some great bargains to be had. So that's one aspect. The other aspect is that with more confidence in the U.S., we'll see money returning from overseas. So I believe that the market at the end of the year will be much higher than where it is now.
Much higher, but unrealistic to think that we could have another 20% upside for the year, like the last 2 years, correct?
Not really. I think we've already seen a big decline, 20-odd%, and that can be covered very quickly. You must remember, when you're at the low point, the percentages look very impressive. You know, if you go down 20%, all you need is another 20, it could be 20% up. And so the numbers look very good when you're at the bottom.
Let's talk about China, Mark. You're still unconvinced that it is the right time to be pumping money into that market. What will convince you to put money in China?
What would convince me is a sea change in the attitude of the Chinese government regarding trade and regarding domestic consumption. In other words, the Communist Party in China has got to realize they can no longer have an economy based on manufacturing for export. They've got to shift to a consumer-led economy. Now, if that happens, I will become very bullish on China. If it doesn't happen, then I will not be very bullish.
But it does seem like the trade war is likely to escalate. Let's take a listen to what Trump has to say about China.
With my China tariffs, we're ending the greatest job theft in the history of the world. But I think it's going to work out. They want to make a deal, and we're going to make a deal, but it's going to be a fair deal.
A lot of analysts re-rating China, saying that it is time to buy. It is cheap enough to be buying. Are they wrong?
You see, the problem that I have with China is that if the trade war and basically political war with China increases with the U.S., money in China could be at risk. At the end of the day, if China is got its back to the wall, it may say, look, guys, you can't take your money out. We're keeping your money here. So this is a big, big factor that you have to consider. You know, it's not just about picking the right stocks, but being worried about getting money out. And of course, as you know, shareholder rights in China for foreigners are not very good.
But if you take the view that China's economy is in transition, that it will take time for it to be a consumption-led economy, why wouldn't you be a buyer?
If it takes a year, then it's fine. It'll take about that long. But it's not about it actually happening, but it's about the Chinese government saying, we are going to take these steps. And by the way, it probably will be a result of the negotiations that Trump is now having. In other words, I'm sure the U.S. negotiators are saying, look, guys, you've got to move to a different direction. You cannot continue to have a manufacturing sector devoted only to exports. And I believe that will be a big game changer. And I think will actually be very good for China.
So still a big question mark on China. How about EM ex-China? That has increasingly been the theme in the market. Will that continue to be so?
Well, you know, I've always told people, particularly recently, last 5 years, don't pay attention to the EM index. Look at these stocks in the emerging markets separately. In other words, look at India separately from China. Look at Korea separately from Vietnam. Look at Vietnam separately from Thailand, because each market has its own life. There was a time when these markets tended to move in concert, but no longer. I think those days are over. So it's best not to look at the index, but to look at the individual countries.
Let's take a look at the individual countries, the likes of Indonesia, India, as you say. Even the Philippines are pretty much buffeted from the impact of the trade war. Would those markets be the ones we should be looking at, be invested in?
Definitely, you should be looking at those markets because they're going to be benefiting from the trend towards China moving away, if this happens, moving away from export-oriented manufacturing. This will be a big change and will be very good for these countries. As you know, Vietnam also already is a huge exporter of goods to the U.S. And I think India, of course, will be really the big winner in this regard. Lots of exports, not only of consumer goods, but of electronics and so forth, will come out of India.
Talk to us about what you're doing in India. What's looking attractive there?
What we're looking at India now is in the software area. And more we're looking at the electronics hardware. Now, this is very preliminary because it will take time for them to ramp out manufacturing for computer hardware and electronics generally. But the future there is very, very good. So now we're just looking at the software side, and eventually we'll be looking at the manufacturing side.
Might India still be caught in the crosshairs of the U.S.-China trade war? In the end, it exports services, and services may be slapped with tariffs as well.
Oh, definitely. India is being slapped with tariffs already. They're already being hit by the U.S. tariffs. But I believe they will now begin to realize that it makes sense for them to loosen up and make an agreement with the U.S. I think the U.S. is very eager to make an agreement with India because that would be the alternative to China. So India is in a very strong position to negotiate a favorable tariff policy with the Trump administration. And I think this is going to happen in the next 3 to 5 months.
Mark, just one final question before we let you go. Don't want to put you in a spot right now, but what's the asset class that's positioned to outperform if the trade war lingers on?
At the end of the day, it's the equity markets that will do the best. Equity markets have been hit badly. Almost every market has been hit. And I believe these equity markets will be doing very well. And that includes the U.S. Of course, India is continuing to outperform the U.S. and will probably continue going forward. But nevertheless, the U.S. market will do quite well. And some of these other emerging market countries I mentioned benefiting from manufacturing for export will do as well.
Mark, thank you so much for your time. Great insights. Mark Mobius, chairman of Mobius Emerging Opportunities Fund. Still ahead on Insight, the strategic view on President Trump's first 100 days with former NATO Supreme Allied Commander in Europe, General Wesley Clark. And then the Boston Consulting Group's Asia-Pac chair joins us to gauge the trade war's impact on business in his region. Much more ahead. Keep it here with us. This is Bloomberg. Let's take a look at China assets lacking conviction right now, currently flat, 37.76 for the CSI 300 index. Of course, China manufacturing slumping on those U.S. levies, spurring stimulus calls. We had PMI slipping into contraction with the official manufacturing purchasing managers index falling to 49 from 50.5 back in March. Still ahead on Inside, retired General Wesley Clark will be joining us with his insights on President Trump's push to end the war in Ukraine. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. President Trump branded himself as a peacemaker and unifier during his second inaugural address. But recent changes in his foreign policy stance have tested Washington's allies and foes alike. In a span of a few months, Trump has threatened takeovers of the Gaza Strip, Panama Canal, Canada and Greenland. And who could forget his fiery exchange with the Ukrainian president in the Oval Office, which came after he refused to blame Russia for the war. Let's bring in our next guest. Retired General Wesley Clark served as NATO's Supreme Allied Commander in Europe in the late 1990s. And after a highly decorated 34-year career in the U.S. Army, now runs his own consulting firm. General Clark, good to have you with us. I mean, Trump came to power saying he wants to bring about peace. Isn't it true, though, that after his first 100 days, the prospects of a major war in Europe is higher than ever?
Well, that's unfortunately true. And that's because the United States is hinting and saying publicly, actually, that we want to disengage from Europe. We're opening the door to Mr. Putin and Russians' aggressive plans. And so we're already seeing the buildup of Russian forces in Belarus, opposite Finland in the north. We know that he's receiving equipment from China, from North Korea, from Iran, and not all that equipment is showing up in Ukraine. You see in the press sometimes, all these Russian soldiers, they're reduced to riding on motorcycles or something. Well, there's a lot of heavy equipment behind it, but it's being saved up for the next assault. And that's probably coming against the states in Eastern Europe that used to be part of the Soviet Union.
Isn't it also true that we are already seeing the fallout? We have the Europeans thinking about, boosting the defenses, spending a lot more and not relying on U.S. weapons. We also see how South Korea is considering nuclear power. I mean, can you undo some of those things that we're seeing right now?
Well, it's going to be hard even for the next president, assuming it's not President Trump, to undo these things unless President Trump switches course right now, because the tariffs and other things that he said and done, they sort of give an atmosphere of inconsistency. And the question is, will the U.S. be a reliable ally? Now, these announcements that the Europeans and South Koreans make, they don't change the situation immediately, at least as far as the concrete military power is concerned. And this is the danger. So when President Trump or the vice president said, well, we may walk away from Europe if these Ukrainian peace talks don't work out, we'll just leave. That's fine, but don't leave militarily, don't leave NATO, don't draw down those forces in Europe, because when you do, you're opening the door to Mr. Putin's further announced plans. Just in the last couple of days, Sergei Lavrov, the foreign minister, has said that Ukraine not only can't have its areas back, but it can't have any weaponry. It's got to be demilitarized. And another spokesman for Moscow said that these East European countries could face nuclear strikes. And so there's a whole lot of intimidation going on. And that intimidation is happening because they see an opening provided by the United States.
Can the U.S. still be a good ally for its partners? Would you be surprised if, some of the U.S. allies now are hedging their bets by warming up relations with China?
Well, I think that's no doubt in the cards. But there will also be groups in Eastern Europe that would be warming up their relations with Moscow. And, for 10 years, the United States has had this focus on China, as though China's the only threat. Well, look, China wants its day in the sun. China's a big country. China's building up its military. But right now, there's war going on in Europe that would have been unimaginable 5 years ago. And Europe is really the major geostrategic prize in this era. Europe is 500 million people. It's got educated workforce. It's got capital. And it's in the American sphere of influence. Both Russia and China would like it. And so it's irrational for us to say, okay, we're not interested in Europe. We should be very interested in Europe. And if we're strong in Europe, the deterrent effect can carry over to the Western Pacific and impact China.
We talked about how U.S. credibility has been dented. What would you like to see in the next 100 days that would help the U.S. regain that credibility?
Well, I think the first thing is stop talking about leaving Europe and watch out for this new defense strategy that's likely to be published that says we're going to cut the army and pull out of Europe. That's the first thing. Second thing is, I think it's time for the president to stop threatening that he's going to put sanctions on Russia. Put sanctions on Russia. Increase sanctions. Maybe secondary sanctions. It's not just on oil and gas. It's on other goods. When we put the sanctions on some countries, like Russia, the trade in those very same goods goes way up in countries like Uzbekistan, Kazakhstan, that are just buying it and then selling it back to Russia. So there's ample opportunity to tighten the sanctions. If we do that now, if we do it forcefully, maybe it will slow Russia's momentum. The alternative, of course, is to announce again another big ramp up in military support to Ukraine. Of course, Kyiv would welcome this. And by the way, that war is not lost to Ukraine. It's just that Russia is marking its time. Russia's still preparing an offensive in the northeast. Russia still wants Odessa, and if that happens, we might have a fait accompli, and that would be really bad. That would be America's and Mr. Trump's new Afghanistan. We don't need that. The
messaging in Ukraine has been pretty confusing. It wasn't too long ago that Trump said that, we're quite close to ending that war. And now the messaging is about possibly walking away if the deal is not struck soon. How do you see this playing out?
Whenever diplomats are out there talking, and I did this with Richard Holbrooke for Bosnia, so I know how he operated too. There's always this desire to get a public momentum going. So that people always want to say, hey, we're pretty close, we're pretty close, we're pretty close. But the truth is, Russia hasn't made any concession, and Russia's tightened its position. And what Russia is doing is basically talking while fighting. And when it gets a concession, it pockets it and then asks for more. And so, yes, the president's getting frustrated. But in diplomacy, you can't just set a deadline and say, if I don't get the deal, I quit. Instead, you have to change the conditions so your negotiating adversary sees it's in his interest to conclude the negotiation rather than drag it out. And that means either sanctions or ramping up military assistance to Ukraine, and doing it now.
Some are suggesting that Trump is actually doing Putin's bidding. What do you think?
Well, I don't know. I can't, project everything. But what I see is the shape of the new administration strategy, which is, and it's been pretty widely broadcast by the vice president, by the secretary of defense, and by President Trump in his comments. And it is, you folks in Europe, you're on your own. You're not spending enough. Maybe we won't even be there if there's a crisis. There's all kind of hints like this. Now, I'm getting the feedback from my friends in Europe that they don't take this very well. And on superficial, what they're saying is we're not giving up on the United States. But underneath, they're pretty angry about the United States having walked away. And let's be very clear. Yes, we've always done more than our share in some way militarily with respect to deterrence in Europe. But also recognize that those forces that have been committed to deterrence in Europe have been available for the United States to use elsewhere. Europe, for us, is a major platform for helping Israel, for trying to contain Iran and doing other things in the Middle East. Without Europe as the stepping stone, as the base area, it would be much more difficult to do what we need to do in the Middle East and Africa. So the forces there are really dual-purposed, and sometimes we forget that in the discussion. I hope the administration won't forget it.
I'm just wondering how you're assessing the fallout in Europe. It has forced Europe to come together, be a bit more unified, and perhaps think about what it can do for its own defenses. That's not necessarily a bad thing.
Well, I think they should do more, and there's been a lot of rhetoric. The concrete actions we're seeing are increase in German defense expenditure. Yes, that's good. The Scandinavian countries are clearly doing more. They are frontline on the threat. Finland and Sweden understand it very, very well. Of course, the Baltic states, who are also members of NATO, see it very well. And some of this is very constructive. Some of it's pretty frightening, like the city of Vilnius in Lithuania preparing evacuation plans in case of a Russian invasion. And so they take it very, very seriously. Poland's taking it very, very seriously. But for countries in Europe, it takes a while to reorient programs, to further ramp up defense production, to produce more artillery, get tanks, and so forth. And there's some things only the United States produces, like Patriot missiles, and they're desperately needed in Ukraine right now. So any suggestion that we would sort of turn away and cut off that support would be really devastating in terms of protecting the civilian population in Ukraine. So I think Europe's doing more, but they will always need the strong leadership from the United States to face up to a nuclear-armed, strategic nuclear power like Russia.
Apart from Ukraine, General Clark, where are the potential flashpoints? What are you most worried about?
So I think for us looking at Europe, Moldova, Georgia are both threatened. The Baltic states, Latvia has a large Russian population. Lithuania is the bridge between Belarus and Kaliningrad. And behind the Baltic states, of course, are Finland and Sweden. So those are the flashpoints there. But I think also what we've seen now is a Chinese assistance going to Iran. That's the big explosion that occurred a couple of days ago on the Iranian docks. We've seen that. The administration's already put sanctions on those companies that provided the rocket propellant to Iran. That's a good thing. The Iranians are still aiding the Houthis, and we're still in a fight with the Houthis. Air power alone hasn't done it yet. The Brits have joined us in that fight now, but it's still a problem. And beyond that, there's still the pushing and shoving in the South China Sea, the buildup of Chinese forces. Xi Jinping has said 2027 is a key date. And so we're worried about that. South Korea, of course, sees this. They see North Korea assisting Russia. That raises the tension on the Korean Peninsula. And when they hear some inconsistency in American speaking, they think maybe we need a nuclear weapon. So what we don't want is nuclear proliferation.
Right. Enough flashpoints to keep you up awake at night. General Clark, we thank you so much for your insights today. Retired General Wesley Clark, former NATO Supreme Allied Commander in Europe and Chairman and CEO at Wesley K. Clark and Associates. Well, still ahead on Insight, we continue the conversation on President Trump's presidency and trade policy with a focus on the Asia-Pacific. Boston Consulting Group's Neeraj Aggarwal will be joining us next. Keep it here with us. This is Bloomberg.
Concerned about the chaotic state of U.S. policy.
I think he's frustrated at this point. Certainly deployed a lot of leverage, probably more than was prudent, and now he's in a pinch.
This is really, killing the appetite from the world to the United States.
It's not commercially viable.
I think that will be the future. More localization.
I think probably less so on supply chain.
They're impacting sentiment, they're impacting people's mind space.
We are focusing on the non-U.S. market for now.
We also need to be concerned about how our actual customers in the U.S. are going to react to this tariff increase.
And I think that's probably a good assumption.
You really see some fatigue of decision makers in manufacturing and also in the distribution sector.
It is literally still unfolding. The story's not finished yet.
It's about being again level-headed, calm, and come to the table for negotiation. I think that's the right move.
President Trump is a business person. He understands the value that Korean companies have placed in the United States.
Some of our guests in the region talking about President Trump's first 100 days. Well, joining us now to discuss how U.S.-China ties are affecting the future of global trade and business, particularly for Asian nations, is Neeraj Aggarwal. He's the Asia-Pac chair of Boston Consulting Group. Neeraj, good to have you with us. We know that the wall is settled with the tariffs, and Trump has called it a necessary medicine. But 100 days on, it's still quite unclear what the objectives are.
So, Haslinda, I was on this show 100 days ago. exactly 100 days ago. And a lot has changed in the world as we see it. I think the best way I would start is look at it from the eyes of investors. Okay. As BCG, we did an investor survey recently. 100 days back, about 65% of investors were bullish about the US economy. That number is down to 20% now. So that's a sizable drop. Second, many investors are saying more than 70% of them are flummoxed by the amount of tariffs and the breadth of tariffs. So that's been the second point. But the third point is, having said both of those things, they still expect the companies, 80% plus of them say they still expect the companies to deliver exactly the same outcomes.
How?
So yeah, that's the challenge. Now, from a company's point of view, what is happening? From the company's point of view, they're all beginning to deal with volatility as become that part of the lexicon in every room, not just a boardroom, but in every management team room, right? So that's absolutely out there. All the big investments are frozen right now because when you have so much uncertainty in the world, how are you going to make a big capital call? You know, you're basically down to the more basics thing. And the companies are getting pudgier. Have you heard this phrase before? So they're adding people to deal with this uncertainty in the world. They're adding people across the rank and file to deal with all these complexity of tariffs and other things. So they're getting pudgier is the word I would use. So those are things which are happening.
But the thing is, they're sitting on the hands and not investing the way they would like to. How can they grow at the pace they anticipated initially? You can only imagine global growth would slow down. The growth in this part of the world will slow down. Companies can't be doing better.
Absolutely. So the companies, what is the playbook the companies are going to use in this context? The playbook that companies are using, to my mind, that what we see across all the leaders we talk about. Number one is they're trying to exercise a full commercial playbook. What do I mean by that? Use the levers of pricing, marketing, right? The internal levers. Use the lever of product portfolio. Products which have narrower margin, maybe you want to go low on that. Stock up an inventory because you don't know when you'll run out of inventory. So that's a commercial playbook. Big reorientation on the supply chain. That's the second aspect which you're seeing. On the supply chain, basically one is geographical footprint of the supply chain. The second is companies are actually strangely going more on AI because they feel there's pressure on the margins. There's pressure on getting more productivity. So they're saying AI can help us get there faster. And they feel 20 to 30% productivity would come out of AI. So that's another thing which is happening. But they're all investing in scenario planning, and they're also trying to see if they can do policy advocacy because they hope this will not last forever.
A lot of Asian economies are export dependent, and it is about being able to be cost effective. With those disrupted supply chains, chances are costs are going higher. How cost effective can Asian goods be versus elsewhere?
Asian economies have deep advantages. While there's disruption in the world, those advantages are very eternal. Let me enumerate those advantages. One is there's always been a cost advantage. Take manufacturing. Asia has roughly an 80% advantage on the cost of manufacturing, some of the lower cost nations. On resources, some of the most critical resources, lithium, nickel, all of those are 70 to 80% out of Asia. So those are big advantages. But these are historical advantages. Asia is also adding newer advantages, which is about innovation. There's a lot more investment in R&D out of Asian countries, which is the investment in what I call cultural influence. You see entertainment, you see beauty. Asian countries are now playing at a roughly equal level to the Western countries, and also capital for risk appetite. So you are combining the historical advantages with these new advantages, and I think whether there's a tariff world, whether a high tariff world, these advantages hold you in good stead.
The big question is whether investments are coming into this part of the world. Take a listen to what Trump had to say when it comes to Apple and its investments.
Apple, great company, was building everything in China. Now they just announced that they're spending $500 billion to invest in America, not in China.
And if Trump is right, Apple is not the only company. In fact, NVIDIA and the other companies that he mentioned are also rerouting their investments. How will this impact this part of the world?
So a world order which has lasted us 8 decades is in for a change. One of the change which has happened, I talked about supply chain, is also reindustrialization. So in companies, as they think about future capex, are going to broad base that. But these are examples of something which is happening in one part of the world. Equally, some other parts of the supply chain or capex may move to another part of the world. So I think from a company point of view, I would go back to the basics. They are basically trying to say the world is very uncertain. I need to de-risk myself. I need to invest in scenario planning. And I need to de-risk myself in multiple different situations. So hence, where do I deploy future capex? Where do I put my supply chain? What products do I go after? What products I don't do? All of those are questions they're going to go after.
How much damage has already been done to the global economy? And how much is that not reversible?
So it's an excellent question. As I said before, the world order of the last 8 decades has been disrupted, right? And going back, once you create so much disruption, once trust is breached, it takes a long time for it to come back, right? That being said, all actors are acting knowing the best that they can under the circumstances. So will we go back to the same old world? I don't think so. But will we find a new equilibrium? Yes. And the new equilibrium could mean many things. Let me give you a few examples. So in the global south, there are 63 countries which do more trade with China than they do with US today, right? This could be more global south to global south coordination. You know, that could happen. I talked about reindustrialization. That's another change which will happen. The supply chains are going to get reorganized. Technology will play a major role. So we will enter a new world order. We will enter call it a new equilibrium. We will certainly move from a starting point of today to a very distinct ending point of tomorrow.
So how might it look like in 4 years' time?
I think there are a few things which you can be more certain about, a few things one will have to, basically be ready for and be more agile about. The few things one can be more certain about is the fact that technology is going to become more pervasive. There is this extra, we're talking about the 100 days, but there is this big vector of change which is happening on the world of AI and technology. I think almost all companies are gearing up for being much more native in this world of technology and being more native in the world of AI. And depending on your industry, it may have different parts of your workflow may get impacted, but that is certain that everybody will embrace that. Yep. It is more certain that people will diversify their footprint, geographical footprint and supply chains. I think that is a given. But which markets you go after, which markets you win in, that will depend on how the world really transpires, and that's hard to speculate.
Because the uncertainty continues. Neeraj, thank you so much for that. Neeraj Aggarwal, he's the Asia-Pac chair there of Boston Consulting Group. Now, we've been talking about Trump's first 100 days. Let's leave you with how the markets have done in those days. Of course, he promised a boom in the markets. We've seen how much damage he's done. In fact, the S&P 500 is down more than 7% in the 100 days. And you can see that the other asset classes have also been slammed. Take a look at where we are in terms of the dollar, lower by 7%, and crude down by more than 20%. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.